here at the office. So I'll go ahead and get started. I think everyone's here now, so we'll go ahead and push through. So if we want to get Amber's all over it. Thank you. Thank you, Amber. So let's see. I'm going to go backwards, though. Oh, wait. There we go. Thank you. And we'll go there. So a little bit about me. Who am I, right? So why do I get to stand up here and teach you guys about lending, right? Or at least tell you about lending. So I started out in lending in 2000. So January of 2000, I started in lending. I was a loan officer at the time. I was a loan officer for about 6 months, and they said, hey, you're really good at this. We should make you a sales manager. So they made me a sales manager, and I lost like half my income. I was a sales manager for about a year, and then they said, you know, you're really good at being a sales manager. You should be a branch manager. So then I became a branch manager, and I lost another half of my income. So as a branch manager, I ran a purchase branch for a company in Arizona. I'm from Phoenix, Arizona. And I did that for 3 years until we hit right? So we hit that area as a branch manager, and the company kind of went under. So I kind of looked around and saw that loan modifications was like a big business, because now that we had put all these people in these houses for things like, oh, you can walk and chew gum? Here, sign this, and we'll give you a $500,000 house. So all of those people, unfortunately, were being foreclosed upon, and so I opened a loan modification company, and I had that company for 2 years. So I was still basically doing the same thing, just modifying loans versus refinancing loans. Well, I did it well enough to where Bank of America decided, hey, you know, you do this pretty well, and we keep getting all your loans. It'd be great if you just come work for us, and then you don't have to have your own company and all the overhead. So I became a VP at Bank of America for loan modifications. So I spearheaded a group of traveling traveling underwriters and auditors across this great land for events that you may have heard of, where people would take all of their documentation down to like a civic center or whatever their biggest building was in that city. And basically within 8 hours, they would get an answer. So you may remember during the loan modification era that people would say, I've sent my stuff into my bank 10 times and I still haven't got an answer. Or you'd hear horror stories where people would lose their house and they find out later on that we had all the information, but we just didn't get, the departments weren't talking. So they started that individual group, and I spearheaded that for about 2 years. So I got burnt out on that. So I went back into the other side of lending, which was underwriting. Well, why is that important? Because underwriting is basically how we determine if you are approved for a loan. So I did underwriting for about 3 years, which was fun, but very boring, and didn't consist of any of this stuff right here, which is talking to people, which I love to do. So after about 3 years of underwriting, I went into compliance, and I was a compliance officer for a bank. Some of you may have heard of Citywide Home Loans that's here in Colorado. Some of you may even deal with Citywide Home Loans. So I was the director of compliance for 2 years for Citywide Home Loans. And until Citywide was partnered and bought out by another entity, that's what I did. So
hey,
after
Henry,
that, yes.
Are you ever satisfied?
I'm never satisfied. And that's important for your clients. Because what will happen is that they get the all of my experience and everything that I've done, they get that all up front, which is awesome. So the last thing that I did was, when I left compliance, I decided that I wanted to take control again of my income. So I started out as a loan officer, and now I'm back being a loan officer. So I've come full circle. So that's a little bit about me and what I do and what I try to bring to the table as far as being a loan officer and understanding your client and getting them done quickly and efficiently. All right, so we're going to start here with Home Buying 101, the basics of ownership. Today we're going to talk about PreQual versus PreApproval. We're going to talk about points. What are they? We're going to talk about red flags during your initial consultation. Now, I was lucky enough to spend some time with some of you, and when you guys were doing, was it seller presentations and buyer presentations? Which I thought was really fun. When we sold our house, we never did that because I knew so many realtors. I just said, you can do my house, and we moved on. So I've actually never been through a buyer or seller presentation. So that was really cool for me. First-time home buyer resources, the EasySign that we have at Movement Mortgage app and then we're going to answer any questions that you may have. So at this point, because we're just now starting, we'll probably go to about 11:45. So if anyone needs to drop out, please let me know, or please just go ahead and drop. But we'll probably go to about 11:45, and then I'll give you 15 minutes for Q&A. Any questions before I get started? No? All right. Then away we go. Okay, so let's talk about why buy instead of rent. So those of you that are sitting in class here, and those of you that are at home, let's see if I can do this or not. Oh. I'm going to show you one quick little flyer here that I think is important for you to see. Really hard to see. Can you guys still see my screen? Those of you that are on the Zoom call? Okay.
Yep.
So this flyer here, which here in class they have actually in front of them, why is it important for you to buy versus rent? This is a very powerful flyer. I think any of you that are doing a first-time home buyer initial presentation, you should add this to your presentation. This is something that you can co-brand with me also. Those of you that are here in class with me, you can see that you can co-brand it also. But basically what it does is it just breaks down exactly what they're paying right now, what they're going to pay over the next 5 years, 10 years, 15 years, 25 years, and what the difference is between renting and buying, okay? I call this the Brooksy flyer. I call it the Brooksy flyer because when she looked at this, it was like a ton of bricks hit her. Like, her shoulders slumped and she was like, I can't believe I'm doing this, and it was just very dramatic. So I now call this the Brooksy flyer for that reason.
Are you gonna send us this deck?
Yeah, I don't think we can see it.
Okay, thanks.
Thank you, Amber. It's just a voice. It's so great. So here's just something really cool that you can utilize for that, and the reason why we think it's very important for someone to buy. So I'm going to go back to our presentation here, but I did want you to see that there. So I don't want to go over why we rent versus buy as far as what you guys are going to say. Obviously, you already have what you're going to say. We don't want to go through all that fun stuff, but it is important that you always have the correct tools so that you can showcase what that is. So let's talk about pre-approval versus pre-qualification, and how do we begin to do that? Let me put this back to where it's taking the full screen. Okay, so how do we begin? 1, 2, 3, right? So you find your home team. So you guys are A. We won't tell them that you've only been doing it for a day. It'll be our little secret. Experienced real estate agent. Then we have our knowledgeable mortgage professional. That's either me or someone that you're working with. And then trusted insurance agent. Anyone here work with insurance agents right now? You know, are there any that you work with like directly right now, or that you decided is going to be on your team?
That's the industry I come from.
Oh, so you've got great resources for that. So you may be a good resource for anyone in this room. One of the things that I found on the insurance agent side, just really quickly, is that it's very important to have a good insurance agent, because that could be the difference between them qualifying and not qualifying. Just another thing that we look at in their DTI. So pre-qualification versus pre-approval. Complete the mortgage pre-approval. Submit the loan application. Collect all the necessary documents. Explore loan options. So A, when they submit the application, that is a pre-qual. That means that they have submitted their information, but we haven't verified it. They basically have told us a story. And that story is that I work at this company and I make this amount of money, and my bank account says this, and my credit score is this. And they told us this great story about what they are, right? A pre-approval is when we collect all necessary documentation. Well, what we consider collecting all necessary documentation is W-2s for the last 2 years, the last 30 days of pay stubs. So if they get paid bi-weekly, it's going to be 2. If they get paid semi-monthly, it's going to be 2. If they get paid every month, once a month, then it's only going to be 1. Their last 60 days of assets, meaning checking account, saving account, 401k if they want to use it, stocks, bonds, mutual funds, anything that they're going to consider for this down payment. I believe, and don't quote me on this, I have a CPA that was telling me about this, but due to COVID, they were allowing people to use their 401k to purchase homes, to take money out of it, and there was no penalty. So you may want to check with your professional on that if you have a CPA or a financial planner. I'm 99% sure that was correct. Just another good way for people to get in the house to use their 401k. And then those are the documents that we use to match up. Now, does anybody know what the percentage of people being correct about their income is from their application versus their actual documents?
2%.
2%, 10%,
Yes,
half, 50%,
30%.
30%.
You would hope 100.
You would hope 100, right?
It seems idiotic to me.
Right? It's probably about 50%. It's probably about 50%. When we talk about self-employed people, and we won't go too far down this rabbit hole, but when they write things off, their income is completely altered. When we talk about hourly people, a lot of times they'll include their overtime, but we can't always include their overtime when we qualify them. When we talk about salary people and they get bonuses and commission, well, because they get those bonuses and commissions, if they haven't been receiving it for 2 years, we can't count it. So in their mind, they believe that that's what they make, but for qualification purposes, they do not. Yes.
So for what pre-qualification versus pre-approval, the
Right.
pre-qual is just that they submit the loan
Correct.
application.
Correct.
And then the other two are the pre-approval.
Correct. So the pre-approval is the application plus the documents. The pre-qualification, just the application.
Okay.
Full approval is when the underwriter looks at it and they determine that you're approved. So those are the 3 stages: pre-qualification, pre-approval, approval. Okay. You can only get pre-qualification or pre-approval in the beginning because you don't have a house. There's no collateral for us to look at, right? So we have to have an appraisal for you to give you a full approval. So that's why you're looking at pre-qual versus pre-approval. Why is this important? The worst thing that can happen to you is that you take someone out, they get happy about a house, they've got their pre-qual, you submit a contract, you're under contract, they do their inspection, they put out $500 for that, the appraisal's been done, they put out $700 for that, and then we get all their documentation and we find out they don't qualify. That is a tough conversation to have with the borrower that just put out $1,200 that they don't qualify. Because the first thing they're going to say is what?
You should.
I had a pre-qualification, because they don't understand the difference. So you as the real estate professional need to know the difference between a pre-qualification and a pre-approval, so that when you're riding people around in your vehicle and they're getting excited about these houses, they actually can afford and they actually are qualified for this.
And also accepting an offer.
And also accepting an offer.
You have to have your pre-approval.
Pre-approval, yes,
Not pre-qualified.
yes.
So what, like right now with the market being pretty tight, with the buyers, do they said that the listing agent or that they want to see a letter
Right.
that is that for to be pre-qualified or to be pre-approved? Which
There's
letter
both.
do they
There's
want?
both out there. So when I submit a letter, it's a pre-approval always. I never submit a pre-qualification. If I submit a pre-qualification, all it is an email to the borrower that based on your application, you're pre-qualified. But they don't get a letter from us for a pre-qual. They only get a letter when they get the pre-approval. Okay. Now it's even happened to me though. So don't take this as 100%. Sometimes we submit a pre-approval letter and then we find out things afterwards that unfortunately they're no longer qualified, or we have to dig into it. I have a case right now, a file right now, where we thought they were pre-approved, but we found out that the wife works for a temp agency. So we have her pay stubs, we calculated them, we have where she works at, that's all fine. But now we know that she works for a temp agency and she may or may not qualify for her income now because of that. So now we're having to dig into that to find out if we actually have a true pre-approval. So that will happen sometimes, okay? So even that pre-approval, not 100%. Not until the underwriter looks at it entirety, okay? Any questions on pre-approval versus pre-qual? Anyone on Zoom right now have any questions on that? No? All righty. So let's get down to the basics of home ownership. Factors of the pre-approval versus the pre-qualification. Your credit history. Now, when we do a pre-qual, just so you know, we pull their credit. So we do have their credit history. We do have their debts. We do have what they believe they make as income. We do have their FICO score. All that is important. Existing debts, employee status. Right now, obviously, with COVID, you know, employment status is huge. Have you been furloughed? Have your hours been cut? Are you still working full time? Are you working every day? That was working 40 hours a week. They're only working 2 days a week, though. You know, that was very strange to us. They're working 20 hours a day, I guess. Down payment. And what's the last one there? I can't even say. So let's see if we can move that.
Qualified income?
Qualified something. You think income?
Income.
All right, qualified income it is. Winner. Thank you. So this is what we're talking about when we talk about pre-approval versus pre-qualification. I need all of these things before they're actually pre-approved. If you're you that they don't have all those things, then the letter that they gave you is not a pre-approval, it's a pre-qualification. Okay? Let's talk a little bit about credit. Now, we put on a credit seminar here back in June, I believe it was. And I know some of you were able to attend that seminar. And we really dove into credit, how it all comes about, what goes into it. I'm not going to go into all of those things today, but I am going to tell you that this is what determines your credit score. This is what's important for you to know as a realtor. You're never going to ask someone what their credit score is, right? But sometimes people are going to say, well, you know, I think my credit's about this. Do you think that's going to be high enough for me to get a loan? You're going to find out that people are going to think that you are their priest, their psychologist, their lender, their insurance agent. You're going to be everything to everybody. And it's the same thing for me as a lender. You know, people call me up all the time and ask about tax. Hey, I'm thinking about writing off X amount of dollars, but I want to make sure I still qualify for this property next year. How much should I write off, Henry? And they'll send it to me in an email. And I send them back the exact same response every time. Unfortunately, I'm not a licensed CPA. I would want you to reach out to a licensed CPA or a financial planner of your choice. Exactly what I send them. I do not give advice on taxes. So what determines your credit score? What types of credit you have? Someone says to you, oh, we just bought a new car. Ding, 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 ding. Red flag. Red flag, right? We're going to go over red flags later, but that's a red flag, okay? Their length of credit history. Oh, you know what? I got a 720. Oh, really? Wow, that's great. How old are you? I'm 19. How long have you had credit? 6 months. That's a red flag. They're probably not going to have enough trade lines. Amounts owed. Ooh, you know, I would love to meet you for coffee. Unfortunately, though, we're overbalanced on one of our credit cards. Would it be okay if you pick up the tab? Red flag. That person has maxed out their credit cards. Payment history. Well, you know, we've got to get out of this apartment soon because we're 3 months behind on our rent. That's going to impact their credit report, okay? So that's what I'm saying, that this is important for you to know, just because you'll hear certain things that you can equate to the person that you're talking to. Not so much because you're going to be telling them, well, you know, you need a 640 FICO for this particular product. You're not going to do any of that. All right, the importance of credit history, and actually we're not going to go through any of that stuff today. How much do I need for a down payment? So I'm going to pull up one of these flyers here so that you all can see it also. I think this flyer is one of my favorites. And the reason why, I think it explains everything so well. So here in the class, they already have this, but you guys can see it now on the screen. Again, we can co-brand these for you if you guys want some. Anybody who wants any of these flyers, like Amber said, she's going to send them to you. I'm more than happy to co-brand them with you so it has your information on it also. What do you think the average person thinks that they need to put down on a property?
10%.
10%?
Oh, I thought 20%.
20%.
20%.
20%,
I think
20%, 20, 20, right? I think it's probably like at least 75% of people out there still believe they need 20% down. Now, we all remember the meltdown that we went through in 2008 when where banks like completely tightened all the restrictions and made all these things possible, or made it really tough for people to get credit. And the reason that they did that was because they had opened the floodgates, and basically if you could walk and chew gum, we give you a loan. And then they basically made it where unless you could actually pay for that property with your liquid assets, then they wouldn't give you the money. This right here is going to be a very powerful flyer for you to have with your buyers because it showcases exactly what the requirements are. So if you're talking to them and they say, well, you know, I looked at Credit Karma and Credit Karma said I was at a 620. All right, great. Now, Credit Karma is the Zillow of FICO scores, just so you guys know. I know you guys get that reference. But if they say they have a 620, they probably should at least have over 580. All right. So let's talk about the four different ones that we have. So FHA, we use FHA for borrowers that are going to have high DTI. Who in here knows what DTI stands for? Debt to income. Jenny in the corner. All right. So she said debt to income ratio. And how do we achieve a debt to income ratio? Anyone know?
Your income divided by your debt.
Income divided by your debt. Very good, Danielle. So all we're talking about is that we need to look at your minimum credit score and we need to look at your down payment, right? But if we look at those two things, we're also going to base it off of what your DTI is, okay? Yes?
What do you consider debt?
Anything that shows on your credit. Great question. So we do not count your utility bill, your water bill. We don't count your Verizon bill or your cell phone carrier. I guess I have stock in Verizon, so I'm pushing Verizon, I guess, today. We don't count any of those things that don't show on your credit report. So basically anything that shows on your credit report. Credit cards, car loan, mortgage, line of credit, anything of those nature. Anything that would show on your credit report is what we consider debt. Anything outside of that, we don't consider debt. So FHA is really good when you have someone that has a high DTI, meaning they have over 50% of their debt is more than 50% of their income.
Say that one more time.
So FHA is for people that have high DTI,
Okay.
meaning that their debt to income ratio is higher than 50% of their income. So if they make $5,000 a month that we've confirmed, and their debts are $2,700, including their new payment, that's someone that we would recommend for FHA. So that's how we determine. So if I ever send you a pre-approval and you see that it says FHA on it, that's probably why. It's because their debt to income ratio was high, and FHA gives me the ability to do that. Let's look at the conventional. Now, conventional, as you can see here, is less down, right? 3.5 for FHA, 3% down for conventional. The difference is that you need a 620 score though, whereas FHA you only need the 580. Okay, so the difference there is that you're going to secure a better interest rate. You're also going to have a better PMI. What's PMI stand for?
Mortgage insurance?
Close.
Private mortgage insurance.
Private mortgage insurance. Ding, 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 ding. Yeah, so private mortgage insurance. Does anybody know what PMI is for?
Mortgage company.
Protect the loan, right? So I have this vision of PMI bear. And the reason why I call it the PMI bear is because all it is that it's this big fuzzy thing that makes the mortgage company feel better about themselves. It just puts its arm around it and it just makes it feel good. What does that mean by that? PMI does not help you as the buyer at all. It doesn't go towards your principal. It doesn't go towards your interest. It doesn't help you at all. It is specifically for the lender to feel better about your loan. It's because you're high risk, and that's the way that they mitigate some of that risk is that they take that PMI. So if they have to foreclose on you in a later time, they've taken money that should offset their losses. That's what PMI is for. So private mortgage insurance, that's what it's for. So on a conventional loan versus an FHA loan, two things. FHA, you never get rid of PMI. it will be there forever until you refinance it to something else. Conventional, it will automatically fall off with enough payments once you reach 78% loan to value. Or if you don't want to wait till it automatically falls off, you refinance your property, you get a new appraisal, and if you're under 80% loan to value, at that point it can fall off.
FHA never falls off.
FHA never falls off.
Did not know that.
Yep.
Almost.
Never goes away. So when I don't have to put someone into an FHA loan, I don't, but sometimes you just have to.
Say the one about the conventional again, it falls away when?
Well, they both fall, well, the conventional falls away at 80 or 78%.
78.
78% naturally. If you want to do it manually, you can get an appraisal earlier. So just so you know, every one of my clients that I talk to that I put into a conventional loan, I tell them all the exact same thing. Once we hit 2 years, I'm going to call you. We're going to refinance you. You should have 20% equity in your home at that time. We'll refinance you and take you out of that BMI.
So
Every single client I tell them.
If you're at an FHA, should you double check the bank? Because I know I have that much equity.
If you're at FHA, though, remember, it never goes away.
Oh, FHA never goes away.
Never goes away.
Conventional's the one that does. at
Correct.
78.
So if you're there now, you should refinance into a conventional so that you can get rid of your mortgage insurance. And mortgage insurance can be anywhere between $100 up to $300. That's significant when you think about that over 12 months. Even at $100, that's $1,200 a month or a year. That's $3,600 in 3 years. So that's the difference between FHA and conventional. Then we have rural. Now, rural stands for USDA. Do you know that the USDA loan that I'm talking about here are the same people that stamp your meat at the grocery store? Same people. USDA is an agricultural loan. They have to qualify. The area has to be labeled a USDA entity. So if you were looking out in, gosh, somebody give me somewhere far that Elizabeth, where there's a lot of farmland and agriculture and things of that nature, you can put that address in to the USDA site and see if it comes up as a USDA approved address. Now, the USDA loan is a great loan. I consider it the veteran loan for civilians. It's 100% financing. There's no down payment. And you can do it with a 580 FICO. Okay?
What are the required, you have to pull up the USDA site
Correct.
to make sure, okay.
Correct. Yep. So on USDA, it has to be on that site. You have to pull it. It has to qualify there. We run a program called GUS, and that does an approval for us. But yeah, 580 FICO score, 100% financing. And then the last but not least is,
Sorry, Henry.
Yeah.
For the USDA loan, do you pay PMI on it?
oh, on the USDA loan, there is no PMI.
Okay. What is the stringent requirements under 640?
It just means that it's, there's some income qualification that you have to have, and there's a couple other things with GUS. They run a couple of different algorithms on your loan, more so than conventional and FHA. It's just like VA. VA has this thing where we do like a net tangible benefit, which I won't bore you with, but basically, if you can't show a benefit for the reason why you're doing that loan, that's not a purchase, they won't do it. So on VA, same thing, 0% down, 580 minimum credit score. It says for purchase only on there for the 580 because we don't do refis at 580. But for your purposes, it doesn't matter because you guys are all real estate agents. So, so 0 down for VA, 0 down for rural. Any questions on any of those 4 programs? Because those are the 4 programs that you're going to be working with for the rest of your career. Those are the 4. Unless I open my own bank and then I do private lending. Then you'll have 5. All right. Any questions from anyone on the Zoom? Nope. All right.
A lot of times when they do new home sales, when they walk in, the first question they'd ask is if they were military. Now I'm getting why. Why do you keep asking that question?
Well, and I'll tell you because, let's see. So the cool thing about the VA is that they make it so you can't charge certain things on a VA loan. So like when I do a regular loan, the closing costs are usually about $3,200 to $3,500. When I do a VA loan, it's like $2,500. There's certain things that we can't charge. We have a $1,095 underwriting, processing, closing, dot draw fee, and just a $1,095 total. On a VA loan, we can't charge it. So that's why they want up your VA loan. Number two, VA loans are 100%, so you know the clients have to come out of their pocket for a lot of money. Number three, and the most important thing, we make the most money on VA loans as lenders. So there's kind of a double-edged sword there. So trust me, if you have a veteran, the lender and the builder are all hoping that that person's a veteran. Yep.
Is it because it's a governmental program?
It is. So the two top programs that we make the most money on, VA, FHA. VA, FHA. Number three is conventional. And to be honest with you, no one really does USDA. Well, we don't really do a lot of USDA here. So it doesn't really hit our, you know.
Question on the USDA, because I've never come across that or having to deal with that. Interest rates and stuff, are they comparable to the other loans?
They're just as low. So
Okay.
just so you guys know, so VA is going to be the lowest on rate. FHA is going to be second most of the time. The rate's going to be lower on FHA, but the MI is going to be higher. So the monthly payment is going to still be higher because your MI is higher. Conventional is going to have the best of all worlds in the sense of the rate you can buy down to be a lot lower. Your PMI is going to be lower. You can get rid of your MI and whenever you need to. So conventional is the best product in the sense of the most flexibility and the best overall. But overall, realistically, if you're a veteran, there's no way that you would go with anything other than a VA loan. VA loan has no PMI. VA loan is 100% financing. VA loan has the lowest. I locked in someone a week and a half ago at 2.6 on a 30-year fixed VA refinance. They paid $2,400 in closing costs. They're going to skip 2 payments because of when we're going to close it. And they're saving $600 a month over what they were doing. It's the easiest loan that we can do. So let's talk about today's flexible mortgage programs. We talked about that. You may be able to buy a home with a very low down payment. We talked about that. Oh, there's the baby. Hello, baby. Sorry. Oh, super cute. Super cute. All right, I've been distracted. I apologize. So some home buyers may be eligible for down payment assistance, right? So if you look in front of you, I know you've all have heard of CHAPA. And let's pull up that one really quickly here. There it is. Now, any of you that have been on the Wednesday meetings, you hear me talk about CHAPA all the time, that they're changing all their guidelines, and this, that, and the other. I won't bore you with all the fun stuff with that, but I will tell you that this is the #1 DPA program. Does anyone know what DPA stands for? Denver Public Assistance. Okay, that's a good guess. Down payment assistance. Give it to Brooksy. All right, so down payment assistance, and basically what it is, it's a program that basically gives a silent loan. They do not pay this back on a monthly basis. They only pay this back when they refinance the property or they sell the property. So first-time home buyers love this program, right? Why would they love this program? Because they're getting free money. So as you can see, we will give 4%. I don't know if it says it on this one or not, does it? I think I have to scroll down. There it is. We have 2 different programs that they offer. They have the grant and they have the second loan, okay? So the grant is exactly what it is. What it says it's a grant, meaning you don't pay it back. The grant's 3%. The difference is that your interest rate that you're going to get is going to be 1% higher than if you do the second loan. So right now, the grant is 4.125%. The second loan that you get.
What was that again? For what?
4.125. That's for the grant right now. That means that they'll give you 3% towards your closing costs, or towards your closing costs or your down payment. So on a $300,000 house, they're going to give you $9,000 to pay towards your closing costs or to pay towards your down payment. Who here remembers how much you have to put down on an FHA loan? What's the minimum on an FHA loan? 3.5%. 3.5% on FHA. So if they give you 3%, then you only have to put down 0.5% and pay your closing costs. So that one works out for some people, but now you're going to have a higher rate because you're at 4.125. If you do the second loan, which is the DPA second mortgage loan, you're going to get 4%. So on that same $300,000 property, you're now going to get $12,000. And on an FHA loan, now you've already done your 3.5, that's all covered. You still have a 0.5% to go towards your closing costs. And remember, you don't pay this back on a monthly basis. You only pay it back on a refinance or if you sell the property. Another good flyer for you to have with you available when you're talking to clients if they seem worried or nervous about coming up with the down payment. Because by now you've already dispelled the whole 20% myth, right? You've already told them, oh, we have great programs, tons of programs out there that 3% down, 3.5% down, or you know, did you serve in the military? If you did, we have 100% loans, right? As you can see on here, it also states that you only have to have a minimum investment of $1,000. So those of you that were on the Wednesday meeting, you might have heard me talk about VA and how you can put someone into a home for $1,000. This is how you do it. Take a VA loan that's 100% financing. Take 4% to cover all your closing costs from CHFA. And the only amount that you have to put out of your pocket is $1,000. Well, guess what two things you're going to automatically pay for on every loan? Yep, and inspection. You're going to automatically pay for an appraisal and an inspection. Inspections run anywhere between 300 and 500. Actually, I see them up to 700 now. So ridiculous. And then appraisals, they're going to run between 650 and 750. Unless you get into jumbo, they can run to 900. Okay. So between those two things, they're going to automatically put out $1,000. So everything else is covered. So on a USDA loan or a VA loan, if I put CHFA on top of it, that person only has to take $1,000 out of their pocket to get into a home.
So do you,
And again, $1,000, I'm so sorry. Go ahead.
do you either have to get the grant for the second mortgage loans or can you combine them? I guess I'm getting confused.
Yep. So no, you can't combine them. It's either or.
Okay.
Either you get 3% for the grant or you get 4% for the second loan.
That's what I thought.
That's it. Yep.
And you said that 1,000 is actually for the inspection and appraisal.
Correct.
Okay.
Yeah, because you're going to automatically pay that. Yep. You're going to be over 1,000, really.
And did you say that you can combine the VA and the CHFA?
I did. You can combine the VA and the CHFA. So think about CHFA as, I usually put this in a car term where I'll say you have an engine and then you add a turbo to it or you add a supercharger to it. But basically you're adding this on top of the regular program. That's what this is. It is a second loan. Either way you look at it, it's a second loan basically, okay? So your first loan is going to be your FHA or your conventional or your VA or your USDA. That's your base loan. And then if you want to add CHFA, that's your second loan that you're going to add on top of it.
I'm getting confused because it's like, why wouldn't you just want the grant? Because there's no repayment required.
Right, so let's talk about the interest rates.
Okay.
So the interest rates on the grant is 4.125. The interest rate on the second, 3.125.
Oh, gotcha.
That's the difference.
Okay.
That's the difference. I tell all of my clients, unless you just have some affinity for doing the grant, do the second loan. Because you don't want to be stuck in the loan at 4.125 for however many years, right? The grant works out really good if you're not really monthly payment savvy. You don't really care what the monthly payment is going to be. And you just want the 3% to put towards, closing costs and things of that nature. I think until that comes down, but you understand, if it's at 4.125 right now, that means that 6 months ago, it's probably at 5. Yeah, so that's the big difference. Right now, 4.125 doesn't sound that bad to you because rates are so low. But if that was at 5, you'd be like, yeah, I'd never do that. So that's the CHFA program. Any questions on CHFA? And again, CHFA is often referred to as down payment assistance, or you'll hear us lenders who talk in acronyms all the time. We'll just say DPA.
Okay.
What's it?
So the grant and the second loan, they're both get paid back at the end when you sell the property or refinance. That applies to both types of loans.
No.
Okay, that's where I'm confused.
So only the grant you do not pay back ever.
Okay,
The grant is a true grant where basically they grant you the money and no payment required. So as you can see right here, I don't know if you can see my finger, but no payment required for that one. And then the second loan, that's the one that they require you to pay it back if you refinance or if you sell the property.
So when does the interest come into play for the grant?
So the interest for the grant comes into play from the very beginning, from day one,
Oh, on the rest of your mortgage.
on the rest of your mortgage. Correct.
So if somebody has this loan and they wanted to refinance, you would have to look at the fact that if they did refinance, that they had enough money in there
Correct.
to pay back the loan before they could even refinance.
Yes. So CHAFA has a program where they can actually refinance you themselves. And if they refinance you, then they keep that second loan subordinated. If anyone else refinances them outside of CHAFA, then you cannot resubordinate that loan. Oh, I'm using lender terms. Sorry, guys. Let's see if we have a.
We have to pay back.
Those are both have things on them. So basically, a second loan is in second position. They are subordinate. They're under the first loan. Okay. What happens is when you refinance though, and you take that first mortgage away, that second loan moves up, and now that first loan goes to second position. Well, the first loan is going to be the bulk of it though. That's of the 80%, 85%. The second loan is only like 3%. So they have to resubordinate so that they stay in the second position, and that first loan always is in the first position.
So go back to refinancing. You said if CHAPA
If-
refinance, then what happens?
Then they don't have to pay back the money.
Ever?
No, they still have to pay it back, just not during that transaction.
Oh.
It's when you initiate it.
It's when we initiate, correct.
So with the grant, is there a certain amount of time before you can refinance that loan?
Not to my knowledge.
Okay.
That's a good question though. I'll check in on that because yeah, like let's say you only have it for 2 years. Can I refinance it now and move on about my business? Because at 4.125, I don't want to stay in that too long. I don't know the answer to that. I can tell you that I've never seen anyone take the grant, ever. I don't even know why they offer it, to be honest with you, but there's somebody out there that's using that grant, I would assume, which is why they offer it. They basically make all of their money back in the interest rate. So that's why you don't pay that money back, it's because you're paying 1% higher than the other.
and that 1% higher interest rate, that applies to that base loan rate? Sorry. Okay.
Correct. So if you're paying, so the rate for CHAFA on the grant is 4.125, and the rate on the second mortgage for CHAFA is 3.125.
So is that interest included in your monthly payment?
Which one?
Like, say 4.125.
Right.
Like, would that be a separate,
Nope, the 4.125 is on the entire loan.
so it's on the whole,
On the bulk. Yep. The percentages that you're getting, the 3% and the 4% that you're getting down, that you're giving you money for, has nothing to do with the rate that you're going to be paying on the entire loan. So just for the grant, you're paying 4.125 on the entire loan.
So with that 4.125, with it being a higher interest rate, and you make your payment each month, does a little portion of that go back to CHAPA?
Well, not a little portion, there's a big portion that goes back. But yeah,
It just.
they're just making money off the rate, yeah, period. Not necessarily your payment, they're just making money off the rate. And I would have to get into how we make money on rates and all that fun stuff, but that would bore you guys to death. All right, so I want to make sure we're hitting all of our topics here. So we hit points, or we haven't hit points, I'm going to talk about that now. Red flags during the initial consultation, we've talked about some of those. Our first-time home buyer resources, so that's our DPA programs that we talked about. We talked about FHA, we talked about conventional, we talked about USDA, we talked about the advantages and the disadvantages of all of those. Let's talk about points for just a second. So does anybody know the definition of a point on a loan?
Well, it helps to buy down interest rate.
Helps to buy down interest rate. Jenny?
the point I mean, a percent.
It's a percent.
Calculated as 1%.
Calculated as 1%. That is correct. So on a $300,000 loan, 1 point is 1%. Okay. So what do we use points for? Anybody know? Jenny?
It gives you a lower interest rate, but the lender needs to make the money back that they're losing a higher interest rate, right?
Well, it's not that we're taking money out to pay back us. It's basically the rates are put out there and they say, in order for us to get this rate, this is what we have to pay to get it. So we just pass that cost along to the borrower, okay? So that doesn't always happen, but a point is 1% of whatever the loan amount is, not the sell price. That's important for you guys to know that because you're realtors, and I don't want you to mistake sell price for loan amount. Here's a quick tip for you. Loan officers are paid on loan amount, not sell price. So when you calculate how much a loan officer is going to make, if you're kind of thinking about it in your mind, never use sell price, always use loan amount. So if you think to yourself, well, I gave that guy a $900,000 house. They put down $400,000, you actually gave him a $500,000 house. So just a quick little thing for you guys to know. I was speaking with a realtor the other day, and she was amazed that we didn't get paid on the sell price. We get paid on the loan amount, so only the loan amount. So a point is only based on the loan amount. $400,000, 1 point, $4,000, right? We use points for discount. So we call them. We are discounting your interest rate. And in order for us to discount your interest rate, that is what we're taking this fee for. There's 2 types of points. There's one for discount to get your rate lower. The second type is origination. An origination point. When do we use an origination point? We use an origination point when we are not able to make a certain dollar amount on the loan due to the program. What's an example of that? CHAFA. On all CHAFA deals, I do not know a lender in Colorado that does not do this. We charge 1% origination. It's because CHAFA has cut what we can make on a loan that we sell them. So in order for us to make a reasonable amount of money on that loan, we charge a 1% origination or 1 point. In the end, it doesn't really matter if it's origination or discount. They all work the same way. If you're talking to your client, you can tell them, if you want to pay points to get the rate down lower, you can do that. That's another way that you get your rate lower. Most clients are not going to ask you about points. If they do ask you about points, they're going to say this. Oh, Brooksy's talking to one of her clients, and she's like, oh, I work with this fabulous guy. His name's Henry Russell. You should talk to him. And they're going to say, oh, does he charge points? That's usually the way you're going to hear about points. And you can always say, no, he does not. Unless it's CHAPA. And there's an origination.
On the points, is there only a certain amount of points that you can purchase? So
There is.
if I'm at 3%, can I buy a full percent and go to 2?
Well, it doesn't necessarily work like that. So let's say that to get down to, let's say you're at 3% and you're trying to get to 2.75, it may cost you a full point just to get to 2.75, okay? And there's a certain amount of points that you can buy down. I won't bore you with the logistics of that, but I would say that in most cases, we never buy down more than 2 points, okay? And a point does not constitute a full percentage down. A point could be a quarter, an eighth sometimes, 3/8. So it just depends on the rate sheet. Okay. So that's what a point is. Any questions on points and why we have them? Nope. Awesome. All right. So this next one I'm going to go through really quickly is the mortgage app, and it's actually another PowerPoint. I'm going to show you guys this. These last 2 things that I'm going to talk about are just tools that are available to you now. Now that we're here with you all here in Keller Williams. So the first thing is, really quickly before I talk about Movement Mobile, is our Easy app. Oh, you got it. So, I'm sorry, our EasySign. So EasySign is the way that our clients purchase or refinance, sign 75% of their documents right on their phone, or their tablet, or their laptop, or their desktop if people still have those. They can do it all seamlessly in their home or in their car or wherever they want to do it. That is a special thing that we have here at Movement Mortgage. So if you have people that are COVID, that are worried about COVID, that's one way that we take away being in front of someone for a long time. The second thing is that they're going to sign 25% of those documents still with a notary or title. So if they have questions, they'll still be able to ask those questions. So it's just a nice advantage to be able to have. So that is something that we offer here at Movement. The last thing that we offer is the Movement Mobile. So this is really cool because it has a lot of really cool tools. Here's the benefits. Benefits me as a loan officer, you as a realtor, and your borrower. The cool thing about this is that a lot of times I'll get a call from a realtor and I'm on my way to an appointment. I'm in my car. And I don't drive like that, but for some reason I have to move my hands for some reason. They'll say, hey, I need to get a pre-approval. You know? Pamela has a client that is right now going up against 4 other clients because it's crazy out there, and she needs to increase her pre-approval, not her pre-qual, to 450. And the one she has right now is 440. And she can't submit that new contract until she has that pre-approval that says that they can afford 450. So she says, hey, Henry, I need you to send me a pre-approval for 450. Well, the cool thing about this app is that no matter where I'm at, I can open it up, hit the client, hit pre-approval, put the 450 in, send. It'll come to you and to the client. I've done this at red lights many times. And the reason for that is that we don't want to be tied to a desk. We don't want to be tied to our laptop. We all have our phone on us at all times. It's that simple and that quick. When I send it to you, I can send it to you in a text or an email. Super fast, super quick. They come over in a PDF. Anybody can use it. Even if you're standing there with the realtor right then, you can say, hey, here's from my lender right now. So here's the cool thing that we use. Mortgage calculator is inside of there. So when your borrower is trying to figure out what that house is going to cost, it's already in the app. Mobile document scanning. This, I think, is the coolest part. On the app, there's a mobile document scanning. You have your phone open, you hit scan, you take a picture of whatever the document is, you hit send, it uploads it to their file automatically. I don't know about you, but I don't know a lot of people that have copy scanner and fax machines anymore in their houses. And remember, everyone was using their stuff at work. But remember, everyone's not at work anymore. So now you can use your phone to scan all your documents. You can even, when you take the picture, you can modify the picture. You can make it more clear. You can do all these fun things with it, and then you can upload it. Prospect activity insights. Every time they open up that app and you're attached to it, you know that they opened it up. I know you guys have the same thing with a lot of the tools that you set up for your clients. So it's nice to know if they're working and that they're looking at things. Real-time status updates. We have like 7 points in a loan. Has your loan been submitted to underwriting? Has your loan been conditionally approved? Has your appraisal been submitted? Have you received the appraisal? Have you received full approval? Have docs been sent? Those are the metrics that you're going to be looking for. With this app, every time something happens, you're going to get it right in your app, and you're also going to get a text message. So it keeps you in communication with what's going on with the loan without me calling you every day. And then the last thing, which I can't see, can somebody read that last one for me?
Add-ons and customization.
Nope, one more time. You're a little bit muffled.
Oh, add-ons and customization.
Add-on customization. So I'll show you guys what that looks like. Basically, once I send you a link and you sign up as a co-marketing person with me, what will happen is that you can your picture is going to show up, your logo is going to show up, all your contact information is going to show up, and every time I send this app to your borrower or to any of our borrowers, I'm going to attach you to it. So you and I are going to show up as a team, just like this. You know, this is going to be Jenny, that's going to be me, and we'll have all this really cool stuff that we can spin on there. Now, another thing that you can put on there is your own links. So if you have a link to your homepage, you can set up to put your own link on there so that when they're in the app, they can just hit your homepage. If you have something for virtual tours or something like that for properties that you already have, you can put that link on there. So the app, when you're going through and setting it up, it will allow you to do that. Empowering the borrower. On-app service, say contact information, calculators, convenient document scanning, loan status. In my opinion, right now, the convenient document scanning is like the most important. Being able to use your phone to send me your W-2 is huge right now. I know it sounds silly, but right now, like last night, I had a client that was uploading all their documents, and it kind of sucks because every time they upload a document, I get a text message. So my phone at 11 goes ding, ding, ding. But at least I know they're doing it, right? So it kind of works out really nicely for you. Mortgage calculators are in there, and it's kind of a sliding scale, so they can just slide it back and forth. FICO score, what the HOA is, calculate. It does this whole diagram. They can email it to themselves. They can text it to themselves. They can text it to anyone that they know. So if you have a husband and wife, and maybe only the wife can go, or maybe only the husband can go, they can shoot them over those numbers. This is what it looks like when they get done calculating. Gives you the monthly, the P&I, the mortgage insurance, the homeowner's insurance. Because do any of you know how to figure out what mortgage insurance, how to calculate mortgage insurance? Yeah, no one does, not even lenders. So we have built it into the calculator here so that it does it all for you. So you don't have to be a rocket scientist to do any of that stuff. It gives you a little graph of how quickly you can pay it off, gives you all the information you're going to need in the world. And when you hit that button right there, it's going to allow you to either text it, email it, or share it. So makes it really quick and easy for you to be able to do that. So I'm going to send you guys links. Anyone that wants the link for co-marketing, I'll need your, I'm going to send you a link and you'll need to sign up for it. That way we can do any co-marketing or co-branding for any of the flyers that I've shown you today. Also, when we do Movement Mobile, if you send me a client, I'm going to tag you as their realtor. And that way, from that moment on, they will always be attached to you. So one quick thing that I'll tell everyone is you'll never have to worry about if I know who your borrower is, as far as who he's connected to, because when they fill out their application, or if they do the Movement Mobile app, they will always have to put your name in. So it would never be a chance for me to be working with a client from Sherry and somehow Danielle ends up getting the deal because she's going to always be attached to it. All right, well, that's all I have for you guys. Questions? You got about 10 minutes for questions. Yes?
On a pre-approval, how long is that good for?
90 days. Great question. 90 days. And in 90 days, all we do is just repull their credit. As long as their credit score stays within the requirements of the program, they're good.
Now, is that a hard pull when you do that?
It is a hard pull. Yep. Every time we pull credit, it's a hard pull, except for 10 days before they close. We do a soft pull to make sure they didn't inherit any more debt. They didn't go to Ashley Furniture Store and buy a new living room set, and now Henry has to work late trying to figure out how to get his loan debt. I'm not bitter. I'm not bitter. Anyone else on the call? Brooke or Electra, Kristen, Patrick, any questions for me on anything that we went over today?
I just have a question. What's the difference between a hard pull and a soft pull? I honestly don't know.
If you're muffled.
You're muffled. We can't make out what you're saying, unfortunately.
Oh, sorry. What's the difference between a hard pull and a soft pull? Sorry, I don't really know.
Oh, no worries. So a hard pull is where we actually pull their FICO score and we see all of their debt and we pull from all three bureaus, TransUnion, Equifax, and Experian. We always take the middle score. So if you got a 719, a 780, and a 655, in our eyes, you're a 719. Forever. So we pull your credit. A soft pull usually is just one bureau. We don't get your FICO score, and it doesn't actually impact your credit score either. So that's why people are always talking about the hard pull and the soft pull and all that fun stuff. But there's no lender out there. That's not true. There are lenders out there that will take a soft pull up front if someone's like shopping and they just don't want to impact their credit. I can tell you myself personally, I would never do a soft pull because I might not see everything that they have on their credit report because not everything reports to each bureau. That's why you have 3 different FICO scores.
Once you do a hard pull, how long does that stay on your credit before dropping off?
From what I understand, it could be over 6 months. It could be over 6, it could be 180 days.
Now, do most lenders do the same as you're speaking of and pick that middle score?
Every lender does.
Oh, they do.
It's not a lender requirement, it's an investor requirement.
Okay.
And the investors are Fannie Mae, Freddie Mac, which I know you guys have all heard of, the HUD, basically, which is FHA, and then HUD also kind of takes care of VA also. They're government entities. The funny thing is that Fannie and Freddie are quasi-government also, but they're technically private companies. Any other questions? All right, well, hey, you guys have been awesome. I'm available in the office. I think I'm the third door on the right or the fourth door on the right. I'm here Tuesdays, Wednesdays, and Thursdays for sure. I am looking to hire someone that's going to be here every day. I know that we don't have a ton of foot traffic right now, but as things kind of get back to normal and people start getting back in here, you know, it's a little bit easier for you guys to jump in and talk to us. We're also going to be hosting a grand opening party next week on the 30th. So that's going to be here. It's a Thursday from 4 p.m. to 6 p.m. There'll be some cocktails, there'll be some finger foods, and I'll be doing the stand-up. No, not really. But we're going to have some fun that day. So please come. I don't know if we're going to have, I'm sure I'll talk to Amber about it. We'll get some kind of registration or something for it. But I would love to see as many of you as possible. Thanks, guys.
Thank you so much.
Appreciate it. No
Thanks,
worries.
Henry.
Thank you.
No worries. Thank you. You're welcome.
Thanks for the swag.
No worries.
I definitely want to get together with
Okay.
you on this stuff.
Okay. Yeah, if you want to just shoot me an email and then we'll figure out a time to get together. And if you want to get together here, that's fine. I have another office in the DTC area, so if that works out better for you. And then, or we can do it virtually, Zoom call, however you want to do it.
And I downloaded your
The app?
mobile, so that's awesome. Absolutely. I'll just work through that. And
Yeah.
put my picture on there and all that good stuff.
That'll be awesome.
I'm excited for it. Thank you.
No worries. I'm here Tuesday, Wednesday, Thursday.
I have a question
Yes.
for myself.
Okay.
So with things
Okay.
we have been pre-qualified.
Okay.
Can I shoot you an app?
Yep.
I would love to. work with you.
Yeah, that'd be awesome.
So yeah, we went down on the lot.
Okay.
The new development.
Okay.
The prices are going up tomorrow. Yeah, and yeah. So how long would it take to get the loan?
24 hours.
Okay.
Okay.
Yep.
Yep, 24 hours. So from the time that we get the application. So if you want to shoot me an email,
Yes.
and then I'll shoot you a link to the application.
Cool.
You could have a little more to chat.
No worries.
If you're watching this video,